Nowadays, everybody knows the price of everything, but the value of nothing. So all it takes is for someone to go to Yahoo Finance or Google or Morningstar, you name the source, and you can look up pretty much any security that's publicly traded and figure out what the price is, what it was yesterday. Don't know what it's going to be tomorrow though. And the key is prices change on a day-to-day basis. We know that. But what are those securities actually worth? What is the value? And that matters. So when I'm training people, people have a hard time with this concept. And what I do is I point at a chair, a regular old business chair, and I say, how much is this worth? People just kind of look at me with blank stares. And I say, well, if I put this on Facebook Marketplace or another place, Etsy, and I was going to sell it for $1,000, who would buy this basic chair? And nobody raises their hand saying, yeah, I want to buy the chair. And then I say, well, what if I list it for $1? Is anyone going to buy the chair? And the hands go up. And they're like, yeah, I'll buy it for $1. Why are they going to buy it for $1? Because they know the value of that chair is worth more than $1. They could probably go sell it for $20 to their friend next door pretty easily. So the price is what's being offered on a day-to-day basis, which is what we see in the stock market. But what's the value of what we're getting as far as the chair example? And I think that's an important concept to understand when looking at securities, because prices can get abnormally high when things are frothy. Prices can get abnormally low when securities are depressed, maybe overly depressed, but how do you evaluate value? So there's different ways to go about that. Certain ways, probably the most used way, is the price to earnings ratio. So that's the price you pay divided by the earnings per share of the company, and that's a ratio. And the higher that ratio is, the more expensive that security is, and vice versa. However, you don't want to take that kind of all in one scoop, because there's lots of different ratios to determine value, like price to book, that's price per share over book value per share. There's price to cash flow, price per share over cash flow per share, and lots of different ways to measure it. But when you're evaluating the company, you also got to look at, are earnings growing? Are they deteriorating? Are they flatlined? Because the market generally pays a premium for growth. So you can pay a little bit more for a company that's growing with kind of a more moderate price to earnings than a low price to earnings on a company that's dying. So that's an important thing to evaluate valuation. And you got to remember, just because something's on sale, right, doesn't mean that it's going to go up tomorrow. Oftentimes valuation, as Ben Graham said, who is Warren Buffett's mentor, it can sometimes take 2 to 3 years to normalize, which is well beyond the scope of most people's attention span when investing, and oftentimes can cause FOMO because they're looking at other things like the S&P 500 that are beating their holdings, waiting for their holdings to revert. So it's a big psychological struggle. It's not an easy game or concept to play. But again, going back to price versus value, we know what the price is, but what is the value of that company or of that fixed income, and how to evaluate that? One other quick point I want to mention is earnings yield. So earnings yield is a unique concept where you can take the price to earnings ratio, as mentioned before, and you invert it, and you do earnings per share divided by price per share, and it creates a percentage. And what that tells you is that if the company paid 100% of its profits or net income as a dividend, what would that yield be? And then you can take that yield and then you can compare it to other things like high grade fixed income, maybe junk bonds and other things, to see, okay, if this company paid all of its earnings as a dividend, what would it be, and how does it match up compared to other competing forces for your money? So that's an important concept to have. Again, you got to remember, this is not to be considered financial advice. Please consult a financial professional for help if you need it. Withdrawal Investing Insights, signing off.